We invent and innovate, think we understand the risks and how to manage them, find out we don't. We have some kind of calamity. But on the back end, we say, okay, now we've learned. But the problem is when you have these machines building the next generation of machines, the rate of change will increase in terms of the improvement of capability. We are, in my view, just not going to be able to adapt ourselves quickly enough to catch up. So there will be new jobs created, and there will be people, I think a small number of people who are at the forefront of understanding how to use these technologies, and they'll be okay. But for the rest of us, I just don't think that's going to be the case.
Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I am Merryn Somerset Webb, and this week I am speaking with well-known short seller and Muddy Waters Capital founder and CEO, Carson Block. Carson, welcome to Merryn Talks Money.
Thank you. Thanks for having me.
You have been talking a lot recently about AI, and I wanted to just start on that straight away, because I think the core of your view is that AI really is going to live up to everyone's expectations of it. It is going to be spectacularly successful. All the worries that a lot of people have about the way that LLMs have hit a ceiling and development is over and we need a new path, all this kind of thing, doesn't come into your view. You think that it's going to be very successful and there will be an employment apocalypse as a result. Am I over-egging your view there?
Let me just state that as background, I was a skeptic. So until February of this year, I refused to refer to any of the models that are out there that we're using as AI. They are large language models. And so I said, okay, these things are not going to ever find the cure for cancer. They are not that intelligent. It's not artificial intelligence. They're LLMs. Now, the current generation of LLMs that was released in January, early February of this year, changed my mind to some extent. They're not going to independently develop the cure for cancer, right? I used to term them the greatest search engines ever developed. And that effectively they are, but their ability to synthesize that information and order that information, there's real labor savings to be had right now in certain areas of knowledge industries, such as investment. I immediately began using Claude to run Monte Carlo simulations that I previously would have needed somebody who was pretty young, recently graduated from a top university, who was strong in math to run. The thing that's important to really understand here that changed my view as to what LLMs are going to do to the labor market is that this generation was coded and tested in large part by its predecessor generation. It is coding and testing its successor generation. So you have a situation where the leading users of this generation of AI model, they're in the technology industry, they are able to supplant by using AI or displace multiple members of a team. Now, vast majority of us are not that skilled yet with the current generation of model, but we extrapolate that we're going to be hitting a point in the not too distant future in which we're going to see exponential improvement in the capabilities of these models because they're coding and testing their successors and so on and so forth. Then you're going to see a lot more capability. You're going to see more comfort in understanding of how to use them. I think it's entirely conceivable that within a few years, 3, 5, 2, you could see within the US, roughly 15% of knowledge workers displaced from their jobs. And unlike the GFC, it's not that you just need to grow your way out of this and reallocate human and financial capital. It's, those jobs are gone and the number of chairs for humans is going to continue shrinking. So that's where I come out on AI, LLMs, whatever you want to call them.
So you lose a lot of jobs, but also the remaining jobs, the quality of them degrades, or feels like that's the end game, that these knowledge jobs disappear. And if people can get other jobs, they might not be of the same quality and certainly not at the same income level.
I mean, a number of these jobs will disappear. I'm a former attorney. I'm a professional litigant effectively now in my current, iteration of my career. And got to tell you, like at present, Claude can handle a lot of tasks that I pay attorneys for. Now, we're all familiar with the hallucinations and it makes up, A versus B. I'm not saying you remove humans entirely, but I mean, if I'm, when you go through discovery, you're paying some associate, I mean, depending on the law firm, you're paying some associate somewhere between, for good law firm, junior associate, $500 an hour to $1,500 an hour to review email after email and text after text, and they make mistakes. Claude does it 100% better. So now you have to query it in the right way. But, when you're talking about, financial service related litigation, most of our outside attorneys, especially junior associates, don't understand what we do anyway. So I think you're much more effective having the client running running the discovery in Claude and querying Claude, at least to make your argument. And that will save innumerable billable hours. So that's a profession that I think is going to shrink significantly in the coming several years. And that's a very highly paid profession.
The problem, I suppose, with that is that you need to train the young people to have the more experienced people available to put in the correct queries. So once your pipeline of educated young people disappears or shrinks significantly, you end up with a problem higher up the tree.
Yeah, but that's, I haven't seen businesses really think too long term about, for a long time, right? I mean, everybody's focused on, how much am I going to make this year? Maybe they're thinking next year. So, and the problem, look, one of the pushbacks to this idea that you're going to see the level of labor displacements that, I think you're going to see is that, oh, well, the adoption curve, technologies are never adopted at the rate at which they could theoretically be adopted. And yeah, that's true. But the thing here is that the cost savings for the providers of these services, the cost savings are going to be so significant, they're going to be able to massively underprice their competitors. So, it's going to be an existential problem for businesses that don't take advantage of this technology and reduce their cost and pricing structures accordingly. So that's why I think that the adoption curve argument here is not going to, or counter argument is not going to win the day, that there will actually be pretty steep uptake of these technologies.
Yeah. I mean, it hasn't happened yet. We haven't really seen this happening yet. It's all still to come, right? And that the number of white collar workers in the US and in Europe is up since the first chat GPT was released. And, there are more AI engineers than ever, et cetera. So it's not yet.
A couple of things.
Yeah.
Well, all right. So the current generation of these models, which was released in January, February, this is the first generation where I said, these are not idiotic. They have flaws, they have limitations, but I mean, previously, yeah, it was a running joke. But, what we extrapolated as humans is that the progress would be linear, and it's not linear. It's going to be exponential because of how they're able to develop their successors. Now, just a little pushback. I'm not normally a macro person, but one thing that, as far as the great job success of the U.S., a lot of that's been in healthcare. And, healthcare is a really interesting sector in the U.S. because, look, on one hand, okay, it's going to grow. I mean, when you go back to 2000, information technology, and look, the way that the BLS classifies sectors is antiquated, really should be updated. But information technology and telecommunications and healthcare are the only two sectors that have grown materially as a share of GDP. And healthcare has grown significantly more as a share of GDP than information technology. So, is it driven by innovation? Yeah, some. Is it driven by demographics? Some. But a lot of it's driven really by the parasitic nature of this healthcare system, at least in the US, that, there's so much fraud, there's so much inefficiency. So, look, if you say the US has a healthy economy, we have a healthy job market because, we've added all these healthcare jobs, I think that's a misinterpretation. So, look, does that really go to whether AI or LLMs are going to make a meaningful dent in employment going forward? No, because as I said, we're really at that point now where you're starting to see how these can replace employees in certain situations, or at least prevent the hiring of employees. And the next generation will be even more powerful.
Okay. Well, we'll wait and see what happens in 5-10 years if new different types of jobs are created. This whole business of jobs we never thought would exist now. 10 years ago, jobs we never thought would exist now. So who knows what will happen in 10 years. But let's take the base case, your base case here, that 15% of knowledge jobs disappear. Now, the interesting bit for the purposes of our listeners and readers, because we are an investing podcast, is what that does to the market. And I think that's where this gets interesting, isn't it?
Yeah. And so, look, again, this has been a U-turn for me because there was actually a podcast I did in January where I was talking about how we had developed this systematic momentum strategy in-house at Muddy Waters. And, it's been compounding for us at north of 70. I think most recently about 90% per year. And I was completely sanguine about the outlook for the market and why, and the idea that momentum, as much as it shouldn't, as much as the fact that the stock has gone up shouldn't determine that it'll continue to go up.
But it does. It's momentum is one of the greatest strategies there is, isn't it?
Especially these days. And a lot of it relates to market structure.
Yeah.
And so this is where what I'm saying about job displacement due to AI becomes a problem. So in January, I'm completely sanguine. Question, Carson, well, when does it become a bad idea to invest in momentum within the S&P 500 index? When unemployment rises materially. Well, when do you see that happening? Not anytime soon. Well, okay, here's the issue. I now do see unemployment, particularly for high wage earners, rising significantly in the next several years. The problem that creates for markets is that, especially with the S&P 500, so much of that is driven by flows. So especially 401k retirement plan contributions from these knowledge workers. And that, and look, when you look at the S&P 500 index, it's kind of ridiculous that we use that as a proxy for the stock market because, generally, 2/3 of the stocks are underperforming the mean of the index, and the mean of the index is really driven by a small number of companies that are outperforming. But what has happened, and so here I reference work that a friend of mine named Michael Green, or Mike Green of Simplify Asset Management, has done on passive investing. And he's been banging this drum since probably 2019 or 2020 about how passive has warped markets. So it's created this virtuous cycle whereby money goes in from paychecks every month. And what happens is these index funds, they buy stock at any price. They're completely price inelastic. They remove supply of stock. And so for the largest names in the index or the indices, if you look at NASDAQ 100, same thing, those get the greatest share of every dollar that's allocated to the index. And so by removing supply, they create this situation in which the stocks that receive the largest allocations, the impact on their prices becomes parabolic versus linear. And that gets turbocharged with stock buybacks. So this has been great for the most part. 2022, there was like a little bump in the road, but we're well past that. So this has been fantastic for investors. But the thing is, if you have, say, 15% of knowledge workers lose their jobs and they're not going to be able to replace that income. They have credit card debt, they have mortgages, they have car loans, student debt. This is going to massively impact the flows into the markets. And so probably the way it plays out on a micro level at first is person who's lost his or her job will sell the taxable investments. A lot of the taxable investments are in the largest names in the S&P 500 index. So you get selling there. But you've already had a situation where that laid off person is no longer making the contributions to the 401k plan. So you get to a point where those contributions go net zero, especially because from a demographic perspective, you do have people now who are also redeeming just because they've retired. And then you get to a point where on a net basis, the flows go negative as people have to sell, redeem their retirement accounts because they've been unable to replace their income. And the issue, so while passive has been this very virtuous cycle on the way up, it's built this significant fragility into the market. And so when those flows go in reverse, there's really not nearly enough active management out there to catch the falling knives, especially because if you were looking at the valuations of some of the largest companies in the indices and trying to look at them on a purely fundamental basis, it's hard to justify the valuations in some cases. So that's where you get, in my view, the GFC type events. It has to do with the fragility that's been created in the equity markets through passive investing. So if you really want to understand my view, it's my own view on AI displacing labor, layered on top of Mike Green's work on passive investing and the vulnerabilities that creates in the equity markets.
And that reduction in demand for equity, so that reduction in flow, it coincides with a period, an unusual period over the last decade of an increase in the supply of equities as well, because we have these big IPOs coming through at the same time. So it's SpaceX, and then we'll get OpenAI, and we'll get Anthropic. And of course, on paper, we're thrilled by this, right? Because it shows the stock market doing what the stock market is supposed to do, which is be a place where people put new money into growth companies as opposed to an investor extraction machine, which has effectively been for the last decade, but most of the money has been coming out in buybacks, dividends, etc. So you get at the same time as, if you're right, of course, that the flows fall, the supply is coming up at the same time.
Right. Now, the other question there, and I don't have a view on this, at least to the extent that it remains independent of labor displacement, but to what extent are the hyperscalers going to continue to be able to issue credit to fund their AI buildouts? Because they need to issue that credit in order to maintain the stock buybacks. So if they can't issue paper at yields they consider to be attractive, then they're going to have to divert resources that would be used for share buybacks to scaling out data centers, et cetera. So you could start to see, that to me, either scenario is equally probable going into when we have this, when these strains start really showing up in the labor markets and the flows start to go toward net zero, can have this situation, like I said, equally probable to me at this point where companies are still engaging in share buybacks. So maybe it hits, that this impact hits more suddenly, or companies have to taper the share buybacks because they're not able to fund in the credit markets. And so you start to see less upward pressure on stock prices as a result of that anyway. So either scenario, at this point, I'm coin flip on those two.
Yeah. And on the demographics, I mean, this was a scenario that everyone expected to happen anyway, just a little further out as the baby boomers work their way through the system and start to sell out to fund their retirements. We would have expected to see those flows reverse anyway. This just brings that forward by, well, probably a decade.
Yeah. I mean, look, I think, My impression of that question has been that there are people who argue, well, it's not going to be that bad because you're going to have the great wealth transfer and, yada, yada, yada. And, money will be reallocated from credit to equities and younger, but, no view in a world that doesn't go through an AI disruption, no view on the timing of that. But yeah, as I said, I think that I think that question is not really going to be that relevant compared to what's coming first.
So let's say we have a GFC style disaster in the markets. It's quick, it's huge, very unpleasant. How does it play out after that? And we're very used to thinking, well, we don't really need to worry about this stuff over the long term. We just hang on because there'll be a government response, there'll be a fiscal response or a monetary response that will make everything absolutely fine. Nothing to worry about.
Yeah, no, look, there will be all of that. I mean, the one thing is the playbooks are now very well developed for, unlike the GFC where a lot of the response was theoretical. It took a long time to implement. Governments had to get authorities to do it. The authorities exist. They've been expanded during COVID. So from a monetary perspective, that, rates, real rates will go zero or negative, over. Well, the interesting thing though is AI is going to be deflationary. So maybe it's a little bit, I'm stepping on a landmine if I talk about real rates, but nominal rates, will be, well below on the short end, well below 100 basis points. Probably 0 to 10 bips, very quickly. And there's going to be a lot of the governments are going to have to buy, the central banks are going to have to buy, the entire curve basically to keep it really, to keep rates, long end rates low. Now, there will be fiscal issues. I think fiscal is going to be a lot more interesting because the monetary playbook is well established. The United States has the blessing of being able to borrow in the currency that it prints. And so I think, QE forever is the future here effectively. But it'll be, one of the third order effects, and where I think it's also interesting to look at some trade setting up, will be what happens in the U.S. to state and local governments. Especially if you look at, the states that are going to have their tax bases the hardest hit are the ones that are the most prolific issuers of debt. So California is, it's because so much of its tax base comes from income taxes, any individual income taxes anyway. This is going to be, like Armageddon for California from a fiscal perspective. So how quickly does the federal government step in and bail out California, Illinois, New York, New Jersey, Connecticut? Now it kind of depends on who, a big part depends on who's in the White House and which party controls Congress. But, from a fiscal perspective, I think the U.S. will be okay because of the potential for QE. The Eurozone countries, that's going to be very tough. But that's where, so look, I think we know what's going to happen in terms of on the monetary side, and they will have to try to reinflate assets, and that will eventually happen. Assets will be, reinflated. But this will reorder society significantly because, the politics, the amount of turbulence that we're going to have to go through, to really figure out how we structure societies, it's going to be significant. And, look, I do think on the back end of this, on the back end of a lot of turbulence, and I don't, this is a number of years to get there. The good news is, I think most people will live reasonably comfortable lives. Okay. I think, a lot of the private sector will be there to serve the government. Governments will be massive employers, massive consumers of highly inefficient products and services from the private sector. So I think a lot of your private sector ends up looking like Chinese state-owned enterprises. Then there's another part of the private sector that focuses on the private sector. It's going to be the leanest, most efficient companies ever. But I think a lot of people, will be working. Your middle class people will be working 2 or 3 days a week. They'll have disposable income. This will be great for small businesses, leisure businesses, travel, etc. I think there will be, our underclass will receive, universal basic income. But and they won't have to work at all. And I hope there'll still be room for people to achieve if they really want to. I don't know, but I've got a couple of kids and I'm raising them with that expectation that, say if they're willing to, put in the work and they have the ambition that they can achieve more than, just owning a cafe. But, I think it'll be great for cafe owners. And in a way, it's interesting because certainly when it comes to AI, I mean, scale, I would think will remain everything. But in so many industries, this is going to be anti-oligopolistic, this technology. So that'll be a nice, if I'm correct about that, that'll be a nice outcome on the back end where small businesses don't have so much of a cost disadvantage to large businesses.
It sounds like you're expecting a massive expansion of the state. That's the net result of this. Every crisis in the West brings us closer and closer to a state that takes up over 50% of GDP.
Yeah, no, I don't see an alternative to that. I mean, otherwise we'll just have tremendous societal instability.
Okay, I was about to say to you, what is the alternative? What are the alternative view? What are the risks to your view? And it sounds like the answer is very unpleasant instability.
Well, I guess, which view? I mean, are you challenging the AI that AI will displace as many people as quickly? I mean, you alluded to one of the counter arguments that Jevons paradox, right? Like new technologies always create new jobs. I don't think this holds this time because the rate of change is going to be for a long time. I'm talking 15 years. Maybe this is just because I'm really cynical, but I've been fond of saying that humans are able to innovate and invent technologies faster than we're able to adapt to them. Whether these are financial technologies such as financial derivatives or deep sea drilling technologies, you name it. So we invent and innovate, think we understand the risks and how to manage them, find out we don't, we have some kind of calamity. But on the back end, we say, okay, now we've learned. But the problem is when you have these machines building the next generation of machines, the rate of change is going to be, and it's going to continue. The rate of change will increase in terms of the improvement of capability. We are, in my view, just not going to be able to adapt ourselves quickly enough to catch up. So there will be new jobs created and there will be people, I think a small number of people who are at the forefront of understanding how to use these technologies and, they'll be okay. But, for the rest of us, I just don't think that's going to be the case. So I don't think Jevons paradox, I mean, look, I've kind of made a career out of laughing at it's different this time because it never has been, but I think it's different this time.
It feels different. Okay. So how does the ordinary investor prepare for this? So our listeners are a lot of ordinary people, ordinary investment portfolios, listening to you talking and going, well, what on earth do I do about this? I don't know what the time frame is. I don't know whether this is a 2-year thing or a 3-year thing or a 5-year thing. Maybe it's a 10-year thing. I mean, who knows? But it sounds like it's something I really need to be ready for. What do I do?
Well, I mean, right now, I think you keep doing what you've been doing, right? I mean, one of the best trades has just been to be long the index, the S&P 500. But you have to be very vigilant and look at what's happening to unemployment, look at what's happening to flows. And at some point, the only place to hang out is cash. I mean, maybe gold, I don't have a view in dollar terms, whether that goes up or down. I think it's going to hold its value relative to other assets much better. But I think to me, that's really what you just need to be vigilant. You need to expect that this is coming. And, right now you could argue that we're seeing signal. I mean, you've had a number of companies announce layoffs and, some of it's due to AI investment, but others are saying efficiencies from AI, but I don't know how much signal versus noise there is right now in these
Yeah.
layoff announcements.
Yeah.
But, at some point, I mean, if this keeps up, 50 million Elvis fans can't be wrong, right? So that's something to pay attention to. I mean, if you keep seeing layoffs and you keep hearing it's because we're automating and becoming more efficient, at some point it's going to be meaningful. And look, maybe there already is signal here. Again, I don't know, but yeah, I think you have to watch employment, unemployment, and flows very, very closely. And the irony of this whole thing, I mean, of my thesis, should it play out, again, the AI thesis, this is mine, the market fragility, this is Mike Green convincing me. But the companies whose stocks have benefited the most on the way up here are the ones that have the furthest to fall, just because of that dynamic, that reversal in flows. Now, as in terms of businesses, they'll obviously be left standing and somewhat thriving, in the wake of all this. And look, one thing we didn't touch on, but I think it's implied, obviously, when if you see that kind of mass high-end labor displacement that I'm talking about, it's not just an issue of flows. I mean, you have an issue with aggregate demand. And so that's going to, so we're talking recession anyway. That'll certainly impact financial results. But look, in the aftermath, these businesses will still be standing. But I think the way, look, you want to be able to protect yourself on the way down, probably cash. We've set up a book in our, we've set up a strategy that's looking to protect principal on the way down. So I think a lot of how, if you were going to try to actually make money on this, I do think a lot of the action is in credit. I mean, one of the things is that, that's interesting about the post GFC environment is that implied volatility in credit is so low because you have these structural bids for credit that are also part of the retirement, flow story. But, if you get this type of scenario playing out, I mean, vol is going to blow out on credit. And obviously you're going to have a lot of credit events, corporate as well as, I'm saying, government credit events. So there is money to be made on the way down here. I just don't think it's the average person should be.
Quite hard for a retail investor to access. So for the average investor, it sounds like what you're saying is you just keep buying until you see unemployment. You really begin to see these announcements ratchet up.
Yep.
Then you get out
then
completely.
Cash.
You go into cash, and then you wait.
And then, right. And then if you really, really want to make the multi-generational money, you go long in the aftermath.
You go long in the aftermath. But how do you know when to buy in the aftermath? Do you wait until you start seeing the policy announcements from the state? You wait until you see QE forever announced again? You wait until...
Yeah, I mean, look, so for UK market, it's hard for me to speak to that, okay? Because I think, the US is going to be, I think we're singularly blessed in this dystopian world that we're heading toward. So from the US investor perspective, that assets will be reinflated. We have no choice. I mean, all of our economies, right? All the developed economies have so much debt in them that the playbook is absolutely reinflate assets. In the US, I think that's, I think, we've seen that accomplished a number of times. They will do that again. So yeah, I mean, if you wait for the first announcements, you're not going to miss the opportunity, if you buy after, the Fed announces that they've cut rates to, 10 basis points on the, on the Fed funds rate. I mean, you're not, you can wait until after that to buy, you'll be fine. But, look, it could take a while. I mean, but eventually, the reinflation of assets will happen. at least in relative terms.
Yeah. And do you think this is
So
going to kill the passive industry? So when we're buying back in, we're sitting in cash, we're waiting, we see whatever signal it says we think gives us a buy signal. Are we going to go back into ETFs, or is this the return of the active manager?
yeah, that's an interesting question. Look, passive will be to blame for a lot of the market calamity, but how much, if we were talking about a financial crisis in isolation, then yeah, obviously, all legislative guns would be focused on the passive investing industry. But we're going to have bigger fish to fry because we're going to be wrestling with this, these existential questions about humanity. Like, what is our role in a world that's, where our work is increasingly being performed by machines? How do we solve that? So, again, so I think, so given that we're going to have some much bigger questions to answer, and they're not totally unrelated, but I think most of the attention will be on that. But yeah, look, passive, Mike has been warning, he's been lecturing policymakers, shouting from the mountaintops for years about what passive is doing. And I think the response that he's gotten at the policy level is like, wow, that's really interesting, but, there's zero political will to do anything about that right now. So, we just have to wait, and, if your crisis ever materializes, then that's when we'll do something. So I think there's awareness of the problem, but it's just a political will problem. Like right now, you'd be taking away the punch bowl in the middle of the party. And that's just not how we run things, post GFC anymore. Not at all.
Yeah. Let me ask you this. You're obviously thinking about lots of existential things at the moment, as am I. What are your kids going to study at college?
Yeah, it's a good one. Look, I do believe that math, and so my kids are not near college age. I mean, 12 and 8. Math and science, I'm very big on that regard. Like, even though I know these things will be able to do all of your math, I think you still need to understand how to do math. So you
want to know how it works.
The end goal here, as I put it to them, is, look, you want to be in a position to use these technologies as a tool, not to have to compete with them. So I do think that understanding the underlying functions that they are performing will give somewhat of an edge. So math and science, and look, reading. So what do you actually study? The world is going to need salespeople.
It's going to need communicators.
Yeah. So I've got one kid who'd be a great salesperson and the other who probably wouldn't be. But, could be lots of jobs in government as well. So I don't know, maybe foreign relations, and you can be a diplomat, trying to control the last, vestiges of what humans actually can control.
Yeah. All right. Let me take you back to gold briefly. You said you thought that might hold its value relative to other assets anyway. What about Bitcoin? Are you a cryptocurrency person?
Oh my God!
Come on,
no.
we always ask about gold and Bitcoin. That's what we do on this podcast.
They're not the same. One exists and one doesn't.
Of course, they're not the same. They're completely different. But for years, we go right back to the early days when people used to tell us that Bitcoin was digital gold, and that made us laugh, and we would call gold physical Bitcoin just for the giggles, right? And we'd ask everybody at the end of each podcast, if I gave you a choice of holding Bitcoin or gold for a decade, which one would you take?
Yeah, gold. I mean, look, okay, so Bitcoin. When my older kid was 5, and he asked me, "Oh, what's Bitcoin?" I said, "Listen, crypto, Bitcoin, these are currencies without countries. Okay, they don't matter. I mean, there is an intrinsic value to them, which is just the gas fees, as they call it, but these things trade obviously well above intrinsic. I've looked at Bitcoin at times in the past as a barometer of speculative excess in the markets, as well as, I think there's a recursive effect as well on speculative activity, and more valuable Bitcoin becomes, so on, the more froth there is in some other markets. So barometer as well as cause. But yeah, look, I understand I think it was Warren Buffett who said that if aliens observed our behavior toward gold, pulling it out of the ground, treating it like it has some tremendous value, they'd be completely puzzled. Yeah, I mean, I understand that, but the thing is, I think it's so deeply embedded, over millennia of human culture. So, every culture, gold wasn't a store of value. Gold was value itself. Could cryptocurrency supplant that or join that in status? Like, I'm not an anthropologist. I'm not certainly not a futurist anthropologist. So take my view with a grain of salt, but I don't think so. I mean, gold is pretty. You can touch it. It has weight.
You can
It's
wear
not
it.
an
You can escape
intangible
with
asset.
it.
Yeah,
And
exactly.
people say
So
to me,
I
you can escape with Bitcoin too. And I'm like, well, yeah, but you're still going to need electricity if you want to escape with your Bitcoin.
still gonna need. Look, I mean, in a really, really, really bad situation, the ultimate stored value is cans of tuna. So I'd rather have cans of tuna stockpiled than a USB drive with Bitcoin.
Okay, well, in when the great crisis comes, can I swap some of my gold for some of your tuna?
Can't eat gold. I don't know.
You'll be able to swap it for something else, though. All right, thank you so much. I'm going to ask you one last thing. It's a quick fire round. This. What are you reading at the moment?
Right now I'm reading. I'm switching between two books. I'm reading a book on the dysfunction in the art market, and I'm also reading a book about Leonardo da Vinci. That's the Walter Isaacson book.
Okay, that's interesting. We should all read that. I think that's on my list.
I gotta tell, it's not that compelling so far. I'm finding it a bit of a slog, and I don't think that's Isaacson's fault. It's just there's not, there's a paucity of information. So he's it's kind of like a book report on, during this year of Leonardo's life, he worked in this shop and he worked on this sketch, and here's a picture of it. It's kind of a book report on his life so far. So I hope it picks up.
Could have made some stuff up.
It would have been, it would have been better. I have perused my bookshelf looking for fiction to because it's just not grabbing me here. So,
all right. Well, maybe we won't recommend that one to everybody. Stick with the first one. With the first one, dysfunction in the art market. That's a lot more fun.
Yeah, that could be. So, that's written by Matt Campbell, Bloomberg journalist. So,
okay.
Yeah.
Excellent. So we can read that while we wait for the great market collapse, and we'll be keeping a very close eye on unemployment numbers on this blog. Thanks to you. Thank you so much for joining us today.
Oh, thank you.